Let's talk about the markets right now because we did see a down day overnight. Paul Dietrich is the CEO and CIO at Fairfax Global Markets. He joins us live from New York. Paul, thank you so much for joining us. Good evening to you. Well, despite the slide that we saw today, markets are near an all-time high, but there's not a lot of conviction. So what gets you excited about this market?
Well, you know, you have to look at the underlying fundamentals. And I think if you look at the market and the economy as it is today in the United States, we have to get rid of the symbolism of the bulls and the bears. We're looking at an elephant market. I mean, it is slow, it is plodding, but it is moving forward. And I think that's the message that we have to take. And if you look at all the underlying fundamentals, unemployment is going down, we're getting record numbers of jobs, real wages are going up, GDP growth, although weak, is expanding, and everyone believes that earnings and sales are going to be coming back strongly in the second half of this year. And so never in the history of the United States have we ever had a recession with those types of underlying fundamentals. And although the market does all sorts of crazy things and reacts to politics and geopolitical events, the fact of the matter is, in the long run, the market follows the underlying economic fundamentals.
Paul, you sound like you're more optimistic for the second half of the year, but for right now, we're in the middle of earnings season. When you look at the S&P 500 companies and digest some of the earnings that have come out so far, how would you assess earnings season with or without the energy sector?
Well, without the energy sector, obviously earnings are better. But still, if you look at all the companies that have basically announced their earnings to date, I think it's something like 70% or close to 70% have outperformed their admittedly lower earnings that they had projected. But we haven't seen that kind of outperformance of earnings projections since 2009. I think that's a good sign.
Okay, you think that's a good sign, but we do have to keep in mind that guidance has been lower and expectations were set lower as well. When you talk about investment strategy, I'm looking at your notes. You say you look for stocks with low PEs and high return on equity. The average S&P 500 company right now has more 17.5 times forward earnings for their PE ratio. That's a little bit higher than the historical average of the past 30 years. So how would you assess some of these companies in terms of low PE and high ROEs, and what are your top picks?
Well, you know, if you look at kind of the sectors, consumer cyclicals and industrials, they're lower. Financials are fairly low in PEs. But we're seeing some unbelievable buys because of the market decline in the first part of this year. I mean, I'm getting companies that I would have loved to have bought at any time, and right now they're on sale. And you look at a company like Emerson Electric, which is a global industrial company, generally considered one of the best managed industrials in the world. It has been hurt by the strong dollar, but this is a company, you know, it's got like a 14 PE. I was buying it when it was back down at 11 PE, 30% returns on equities, huge cash flow. This is one of those companies that you want to hold for a long time if you can buy cheaply, which you can right now. And you look at a company like Apple, and I know Apple's going to be announcing their earnings tomorrow, but it's selling at a 10 PE, has a 40% profit margin, a 47% return on equity, almost a 2% dividend yield, and it's lowered its expectations. And what people have to understand about Apple is that 2 years ago, it introduced the iPhone in China. Everyone in China bought the iPhone. It was like a once-in-a-generation kind of sale. And so now we're seeing Chinese sales plateau out because nobody's going to buy one for another 3 years. And we're going to go into a kind of regular cycle with that. And so I think people have to understand that. But this is a company that has these amazing fundamentals, and what most people don't understand is that it has a quasi-monopoly. I mean, it's not like some software company where if you introduce a better software product, everyone will move to it. Once you get into the Apple ecosystem with your iPhone, your iPad, and your Mac, you can't get out of it. I mean, you have all your iTunes, you have your photos, everything, and they've locked you in. And, you know, the thought of switching to a PC system, you just want to commit suicide before you would do that. And plus, they're like tobacco companies in a way. Every 3 years, you have to buy a new one, you know, just like you smoke a cigarette, you get hooked, you have to keep buying them. The same way with Apple. And to be able to buy that, it's so oversold. I mean, in a month ago, February, I was buying it for a 35% discount from what it was in June. And to be able to buy this company on a 10 PE is just a once-in-a-lifetime opportunity.
And keep in mind, they have $200 billion in cash as well that they can work with. All right, Paul, thank you very much. Paul Dietrich there from Fairfax Global Markets.